Welcome to our Lunch and Learn workshops. Today we have for you planning for your retirement, which is an amazing topic to discuss. The webinar will run for approximately 1 hour and contain general advice. My name is Bianca. I'm a paraplanner at Smart Business Solutions Financial Planning, and I really enjoy working with our team there. We have a great team. We do have time for questions at the end of this session. If you just pop those in the Q&A box down the bottom there, and you should automatically be placed on mute for this webinar. But if not, if you could just pop your webinars onto mute, that would be great. So now to introduce today's presenter, Shannon Smith. So Shannon is a qualified accountant and financial advisor, founder and managing director of Smart Business Solutions Accounting and Financial Planning. Shannon has been advising small and large businesses for over 25 years, and prior to founding Smart Business Solutions 14 years ago, worked for one of the world's leading accounting firms in Melbourne, Prague, Amsterdam, and New York offices. Shannon is an expert in goals-based financial advice, self-managed superannuation funds, and retirement planning. So Shannon is very well positioned to share the latest developments with you. Welcome to Shannon.
Right, great. Thanks very much, Bianca. And Bianca, forgot to mention, she actually started her career actually as a vet surgical nurse. Who would have thought you'd change from vet surgical nurse to financial planning? Bianca joined us a few years ago as administration and then fell in love with financial planning and has overachieved and nearly finished her master's in financial planning, as at the end of this year she'll be fully finished in that. So I've got a lot of great support here in the team, but I'm going to go through one of my favorite topics, which is retirement planning. And you're never too young to think about retirement planning. I always have a kind of saying when I'm discussing this with clients: what do you want to do? Do you want to do a little stroll to retirement, so that you're basically focusing on retirement, putting a little bit aside and stroll your way through to retirement? Or do you want to do that last minute sprint to retirement? Now, I know what I would probably prefer. So you can never actually be too young to think about retirement. It's just going to be how much you're going to focus on it at any point in time during that time. And so obviously the more time you have on your side, the better it's going to be. Just to highlight, because we are dealing with financial advice, financial products, this is general advice. So even if we do answer some questions in the question box, we're not going to have all of your facts and circumstances. So it is general advice, and do recommend that you get personal advice related to you if you have any other questions on it. So the key things I want to go through today, looking at, well, superannuation, what is it? What are some of the different areas of it? So I've got quite a bit to cover on that side of it. I'll give you a few just case studies as well, and then I'll just touch at the end on estate planning. So hopefully I can make what would be normally considered a dry topic of superannuation into something a little bit more interesting. I think the one thing that a lot of us have started to focus a bit more on superannuation is the fact that ultimately it's going to be this significant asset that most of you are going to end up having at your retirement, as we're seeing more and more people putting into super, especially straight from, when they're first starting to work. So it's actually ending up wanting to be a very large investment, and really should be something that you're actually focusing on and making a conscious effort on it. And so when it comes to, I guess, affording a comfortable retirement, this is actually, it is really going to be the most valuable asset you have. So I want to go through today some of the different ways of what is superannuation, what are the different types of supers, but also what does it mean and how can you get money into super? And then also, how do you get it back out at the end? So superannuation is basically, it's kind of an investment designed to help you kind of accumulate money for your retirement. So as you're working, you're building up your super through super contributions, and I'll touch on what all of those different aspects are. And your super fund is then investing in different, whether it be property if you're talking self-managed super, but even in the other super funds, it'll be investing in different assets, whether it be shares, managed funds, to actually get returns, and you actually have low taxes in that super environment. But obviously you can't access it until you actually get to the retirement age. So a lot of people ask me, well, how much is enough? Like, I'm preparing for, in a sense, life after work. How much do I actually need to have a comfortable retirement? And then I guess the key to doing that is actually working out what you probably might want at retirement. And I always say, okay, what do we think that you want to have in a situation for at retirement? A lot of people say to me, look, I want to have my house paid off. So I want my house paid off and I'd like X amount to be actually living on at retirement and enjoying life and doing some holidays and things like that. I actually look at that and go, okay, well, when is retirement? So when would you like to actually retire? When are you thinking about stopping working, whether it be reducing your hours on working or actually stopping overall? And then I like to rewind it and say, well, even if you're running your own business, I put it in the analogy, well, if I rewind that back to today, we have X amount of paychecks to start getting you ready for retirement so that you don't have to do that last minute sprint. What's interesting about retirement, and to put some perspective around it, they actually say, and these are just the statistics, so we can all be, hopefully healthy and live longer, but they say the average 65-year-old man is expected to live 19.22 years from post 65, and a 65-year-old woman is expected to live for 22.05 years. So it really is, it is one of those things that you do need to plan and work out, well, what does retirement look like, and how am I going to afford to have that comfortable retirement that I'm really wanting to look at doing. So when it comes to how much is enough and what amount should we be looking at, and I'll touch on a few of those different areas, it's going to come down to your personal situation, and it's going to come down to when we're actually allowed to travel, but what would that travel look like? And what I see with many people is talking about, well, when is retirement, and is retirement, when do you want to have the choice to retire? And then not only the choice to retire, are you going to fully retire? And I think more and more, and maybe the technology is assisting us with this, is that more and more I see that there's a lot of people that might say, well, I'll probably start to retire at that point, but I actually may not go into full not working at all. I might keep on consulting or doing a day or two a week because of that flexibility a lot of people have. So it does depend on what people's personal situations are. Now, to give you some numbers to put around it, and this is something that when I'm working with clients is trying to work out, well, what are you spending now and what would that look like? But just to put some stats around it, and some of these are, these are the stats that have been sourced from APRA as well. But if you're looking at income in retirement, and if you're looking at singles, but even if I look at, say, the couples, bearing in mind that we're expecting your super to last 25 years, if you're looking income at retirement, you're going to need, if you're saying you want a modest lifestyle, in a sense, and then you're going to need income retirement of 40,054 is what they say the statistics are for couples, which means at retirement, you're going to want a superannuation asset balance of $70,000. Now, that doesn't sound like too much, but on $70,000, on that basis, it means that you're actually heavily reliant on the age pension. So if you've got a $70,000 balance at retirement as a couple, you're heavily reliant on the age pension, and you're having a modest lifestyle. You're probably not having 2-minute noodles, but you're having a very modest lifestyle. Whereas if you are wanting more of a comfortable lifestyle, they say when they're talking comfortable, this is one where you can afford to eat out here and there as you want. You can do a few regular leisure activities, take an annual holiday in Australia, and every few years maybe overseas. So that's the comfortable lifestyle, and potentially you've got your house in a sense paid off, so you're not having that cost. What they're actually saying is that you're going to need, based on a couple, a combined super balance of 640,000, and that's going to be an income of 61,522, and that to be able to last you for that 25 years, and that you're not going to be then in a situation that you are reliant on that age pension. So I guess there's a big difference between what is, I guess, the modest lifestyle and the comfortable lifestyle. And I'm always trying to work with my clients to really strive for coming to that comfortable lifestyle and not being reliant on the age pension. If you are reliant on the age pension, it is going to mean that you're actually going to be quite restricted once you get to that retirement. So the goal is always to see, well, how can we how can we change this outcome? What can I do today to make a change to someone's outcome going forward? Just to touch on what we mean about the age pension, and then I'll get into some of the other areas. It's going to be your eligibility, very much dependent on your age and birth date, and your income and your assets. So, obviously that's extending from age 65 up to age 67. And it does depend on how much of the assets that you actually own, what's your own home versus what you've got in investment assets and cash outside. So with the age pension calculations, it can vary significantly. And just as an example, and I just pulled some of these numbers, it gets updated twice a year. But, couples get a maximum of $703.50 per fortnight, or combined the $1,407 combined per fortnight, and it is treated as taxable income. So that's just a touch on the age pension. But the whole goal of retirement planning, I feel, is actually, unless someone's coming in the day before retirement, maybe, and even then I'll be trying to work out how I can structure them. I want to try and get it so that my clients are not relying on the age pension, and that they have a comfortable to very comfortable, retirement side of things. So how do we go about boosting your superannuation, and what are some of the different ways of boosting the situation? So we have your superannuation. So we have concessional pre-tax contributions, we have non-concessional after-tax contributions, and then we have a few other contributions that are available. So concessional contributions, I don't know why they didn't call it deductible contributions, because that's what they are. That means it's deductible in a sense in your name if you're paying it personally as a personal contribution, or it's your employer's paying it, and it's saving on tax on the outside of super side, so to speak. So concessional contributions will be, at the moment, it's just gone up from 1st of July to 10%. That's going to keep gradually increasing up to 12% by July 2025. But that's 10% of your wages are required to be paid by your employers into your superannuation fund. There's also a way of being able to contribute personally as well, and that can be in the way of requesting a salary sacrifice. So that's where you're getting your employer to withhold some of what would be your normal wage, and they're paying it into your super fund on your behalf, so that you're actually kind of, in a sense, topping up your super or paying more to super, and it's coming from your pre-tax. And I'll go through that in a bit more detail. And then you've got personal tax deductible contributions. Now, maybe not all of you are fully aware that these are available. They used to have quite some strict requirements about being able to make these personal tax deductible contributions, and those requirements have kind of actually gone away. So for the last just under 3 years, it's been a lot more easy. It's been a lot easier for any of us to make personal tax deductible contributions and bring ourselves up to the cap, which is currently at 27.5%, 27,500 for concessional. Non-concessional, it should have been called non-deductible. Non-concessional are actually after-tax contributions. So you've got money, in a sense, in your bank account that you would like to put into a more tax-effective location. So at the moment, any income you earn on that money outside of super will be taxed at whatever your normal tax rates are. If you move that into super, as a non-concessional contribution, you're helping to build up your super for the future. Your super fund, you don't get a tax deduction on the outside. Your super fund also doesn't pay tax. So you're really having the benefit of being able to move money from a high taxed location into a lower tax location. We also have spouse contributions, so I'll touch on that as well. For any of you that may actually have a spouse that's not working and not getting super contributions, there can be some opportunities on that side as well. Then we have other contributions, which is at the moment it's over 65, talk of bringing that back to the 60, which is the downsizer contributions as well. And I'll talk a bit more about that as we go through. And that's about where you want to actually downsize your house and being able to put some extra amounts into super. Now, the reason I talk about some of these limits is when probably for the baby boomers, and it would have been, I reckon, about 10 years ago, any of you that had a spare million back then, you could put up to $1 million into your super back then. And so that was really to give the baby boomers an opportunity to really build up their super. They were selling businesses and to get the money in. But there are caps, and the caps are there to really limit how much money you either A, get a tax deduction for, so under the concessional contributions, B, how much money you get to move from a higher taxed environment and put it into, in a sense, what's a lower tax environment until you retire, and a no taxed environment once you retire. But the other contributions, such as this downsizer, is to enable you to actually put a lump sum extra in there as well. And there's also some others on the concessional side that I'll talk about shortly as well. So salary sacrificing, this is one thing that you see a lot more with the larger companies will enable their staff to do some salary sacrificing. I don't see it as much on small business, and I do encourage a lot of clients to make it known to their team members that you can actually do the salary sacrificing, because it's actually not that complicated as an employer to put it into your system, say such as Xero, and being able to offer that to your team members and help them actually build up their own super. There is the alternative that they can make a personal super contribution during the year anyway, at the end of the year, and do it through their tax. But this is one way that they're kind of getting the tax deduction. You could nearly say straight away, instead of putting the extra into super during the year, and then adjusting their tax rate at the end and maybe getting a tax refund when they lodge their return, this does enable them to get it kind of upfront and not have that cash flow out of pocket. So when you're looking at salary sacrificing, you're basically getting what is your taxable income, your pre-tax wage, and you're getting some of that extra money to top it up, maybe up to the concessional cap, being $27,500 from 1st of July this year. It was $25,000 if some of you remember that figure. Now, do remember there's actually another opportunity as well, which is unused amounts accrued from 1st of July 2018. And that's where we have, if you didn't use up all of your caps up to the 25 for, say, 30th of June 19, 30th of June 20, and 30th of June 21, if your super balances, so there's some criteria around this, but if your super balance, your member balance is less than 500,000, and you missed out, in a sense, in those years, what used to happen is you missed out in paying your concessional contribution and getting your deduction. And it was kind of bad luck. Sorry, 1st of July came around and what restarts again. So the government basically allowed those with balances of under 500,000. And if you think back to the asset base that you would need to have a comfortable retirement, what the government are trying to say is, let's help people try and get closer to that 500,000, potentially then getting up to the 600,000, releases pressure off the age pension, but also provides you a lot better, I guess, retirement outcome as well. So the unused enables you to actually do you could nearly call it a top up of the unused. So if you only put 10,000 into super, a combination of, say, your employer put money into super, or your business put money into super on your behalf, and you only put 10,000 in. At that time, you had $15,000 that you could have put in as extra, but you didn't. You're now allowed to do that, and you can do that as a top up. Just when you do it, just make sure you note that does get communicated to the super fund receiving it, because they get very confused when lots of extra money comes into them. So it's just making sure that you've got the paperwork for that as well. If you've got an SMSF, it's really easy because we can do that paperwork at year end. What it does mean is that you're getting, in a sense, it's going into super, you're getting kind of a tax deduction at whatever your tax rate is, and you're only paying 15 cents in the dollar tax in your super fund on that same income. So you're getting a benefit. It reduces your taxable income, and it's really, really good if you're on the highest marginal tax rate. You're building up your super and getting a tax deduction at the same time. Now, just to look at some of the after-tax contributions that you may make. So there's the pre-tax salary, and this would be money from your after-tax money. So you got the wages, and you might make a personal top-up. Now, sometimes I actually even, so with business owners, I will also even strategize as to how best to do that. So I might actually say, look, we've got the SG or the superannuation guarantee coming out of your business, but if they're on a higher tax bracket outside of super than the company tax rate, then I might put more of the super contributions as basically after-tax money in their own personal name, the personal super contributions. And then the other way as well is this non-concessional. So on the non-concessional, the caps that we have now, and this will be different to what you would have known pre-June 30, is 110,000 per year non-concessional per each. Or you can always bring forward. So if you wanted, and I have clients that sometimes want to buy maybe a property in an SMSF and they want extra money into their super fund, you can bring forward 3 years of those caps. So you could in 1 year potentially bring forward $330,000. And then for those next 3 years, you can't make any other non-concessional. Once you get through those 3 years, it's back on and off you go again. Now the cap, there is a cap overall, and this will restrict how much you can do on the non-concessional when you get to 1.7 million in your super balance, which would be a great outcome. Clearly, that's going to be a very, very comfortable retirement. So when the government announced that amount, and I'll talk about that cap in a few more slides, I actually set that as my goal for clients. This is what the government says is going to give you the cap that they're going to give you as a zero tax on any investment earnings. So let's set that as our stretch goal of what we want to get our retirement balance up to. Now, co-contributions, there may not be too many of you that are eligible for the co-contributions. If you do have maybe it's a non-working spouse, depending on, I guess, the spouse income. But what the co-contributions do is basically the government, if there's income under $41,000 and it goes up to, say, it tapers back up to 56. But if you have income up to there, you actually make a co-contribution. So basically you put $1,000 of after-tax contribution into super, and the government will match that up to $500. Others that it's quite good to do this for is actually even some of your maybe adult children that aren't earning the big bucks yet, because maybe they're even still studying at uni. It's not a bad way to get a nice return, I guess you could say, on putting $1,000 in, governments matching the $500 as well. But there's not as many that are eligible for that. Now, this particular strategy is one that I think that there's a number of people that are probably not aware of this strategy being available. And it's actually quite useful for those that when you're not in business, so you may actually have, and I recently just did this strategy with a client that's an employee for a large company. And his wife doesn't work, and so she hasn't had any super contributed for quite some years. And he's got the maximum every year on the concessional contribution. You actually can have spouse contribution splitting. So what that means, and it helps you actually build up your spouse's superannuation balance, which can be beneficial. It could mean, depending on the age difference, it could mean you get access to retirement money earlier if they're older. It also could mean that you've got the opportunity to balance the amount that you've got in your member balance versus your spouse, so that you're not going over that cap. Depending on the situation that you have for your own situation, I guess. But what it actually means is that if you assume the employed person has the contribution, it's withheld from either their wages or they make extra contributions, they then notify their super fund, and the spouse's super fund gets notified to actually say, look, and they get a deduction in their name. So you get a deduction at the highest tax bracket, but you actually say that I actually want that superannuation to be split into my spouse's superannuation fund, and it goes into their superannuation fund. You can do up to 85%. So that would be 85% of $27,500. That's been a really good strategy that I've been able to do with some clients where they hadn't received advice before, or they've received advice from someone not that smart, I guess I would say. And it has been great. And, their spouse has got literally nothing in super. And for the last, 10 plus years, they've had the maximum in super going in. They should have been implementing this type of strategy. So we're using it a bit of as a catch up at the moment. So we've already gone, okay, they've got quite a decent balance. Let's try and see that if we can get their spouse balance up, because that's going to be beneficial in the future, given the different caps as to how much you can roll to pension or not from that perspective. But just to give you a bit of a calcs, and this is just a really high level calculation on why would you be looking at putting money inside of super versus outside of super. Now, one thing I always do talk to clients, and for those of you that have been working with me closely, you'll know my little buckets analogy, but I look at your you have 3 buckets or financial buckets in life, I can't like to call it. So I say you've got your middle bucket, which is your income earning bucket. And that can be either whether you're employed or running a business, but this bucket is the feeder to everything else. Now, I always say you look at the one bucket often to your left and you say that's the today bucket. The today bucket is money going into the today bucket so that you can pay off your home loan, put kids through school, enjoy life, you might do some investments, but making sure that you actually get the most out of your life, because we're not all just here waiting for just retirement. And depending on how close you are to retirement will be depending on how much time you spend looking at your today bucket versus the tomorrow bucket. Now, the tomorrow bucket, I look at that as being kind of your investments. Now, that can be inside of super or outside of super. And it's about balancing that. When I'm working with clients, it's really about balancing that. We don't want to spend all our time, depending on your age, in focusing on just building up your super, and then find that maybe at age 55, you say, I'd love to have the choice to retire at 55. You stop working, you've got all your money in super, you can't access it to 60, and you've got 5 years of 2-minute noodles or something like that. So I like to actually balance, and that's where some clients, we might do some strategies on their super and then go, okay, and especially, if I'm working with some, say, in their early 30s, they're getting a really good head start on that. They might get a property, we put it in the self-managed super, and we get all of that set up, and then I'll be like, okay, tick, let's just do minimum on our super going forward, and let's focus on today. You've got young kids, eventually when we're allowed to travel, you probably want to bring them to Disneyland and all of those things. So it's about balancing the time. You're never not looking at either of the buckets, but it's about balancing how much time you're spending at different stages of your life to do that. So when you're looking at investments inside of super versus outside of super, it's not just the numbers, it's also where am I at in my life cycle, where am I at with your family, where are you at with your investments. So you might even have a situation where a client might do an investment, I'll have outside of super, and we'll go, okay, let's do that investment outside of super in a trust, let's make a heap of money on that investment you're about to do. Once you get that, then later we'll put some of the money into super and do an investment inside of super. So it's a balancing act as well. But just to give you an analogy as to why what's the tax benefit on this side of things. And I just looked at, if you had an investment, and I just crunched some effective 34.5% as an average kind of tax rate with someone that's on a higher income. What would be your tax on that income return? What would your financial position be, in a sense, after year 1 and financial position after year 2? Now, I've summarized it here, but I actually just calculated it out and actually made it look, the additional benefit just even over a 10-year period with just these, these high-level assumptions was $112,000, on these high-level assumptions. And the reason for that, you've got the higher tax bracket outside of super, and you've got inside of super tax at 15 cents in the dollar. Now, one of the greatest things about super is the fact that once you retire and you've got the money in super, so that's important, you actually get the income all tax-free. So I have a number of clients that I'm working with that we're trying to build up a number of assets. So there might be, buying 1 or 2 assets and using debt on those assets as well in your super, with the goal of, when we get to retirement, maybe selling one of those assets. When you sell it, it's completely tax-free, no capital gains tax, and potentially using that money to pay out some of the debt for the others. You can even take a lump sum at retirement from your super as well. So there's some of these different strategies that I like to look at it when I'm looking at the tax side of it, and look at it holistically. So it's not only about saving the tax, it's also just about personally where you're at from a financial perspective, just to see that we're kind of keeping, I guess, as Bianca mentioned, I'm very much a goals-based advisor. Sometimes there will be decisions that I'll crunch the numbers for you and things like that. I might say, okay, here's the tax outcome, here's the best financial outcome for you. But, to satisfy your goals, actually go do that, go buy that caravan or whatever it is you want to do, because it's going to give you, lots of enjoyment in your life looking at the today bucket. And so there's going to be, I guess it's about getting the numbers there so you can kind of make informed decisions about what you want to do from a retirement perspective. When we look at investing in your super, now and I'll talk about the different types of super funds, but there are, even within your retail super funds, a lot of people probably haven't looked at what was ticked on their form when they first started working at Macca's and they got their, Host Plus Super and they've had it forever. Now, if you haven't actually had a look at it, it's really worth to have a look and say, okay, well, what age am I at and what's my level of appetite to risk and how much time do I have until I retire? And I'm working with, I was working with some clients last week, who are in their mid-20s. So they're already looking at this, which is they're going to just have this slowest walk to retirement and they're going to retire on such a great outcome. I'm financially modeled it right through to retirement. And they've got plenty of time. But it was really interesting. Their super funds currently was set up at basically like this low risk, this moderate risk, which over that period of time was going to go up so slowly on, so if you're quite defensive on it in a sense, and that it's not putting money under the mattress, but it's putting it into maybe some really low risk or low volatility stocks, maybe it's your shares, your bank shares or something like that. Now that does have a place, but if you've got, 40 years until retirement, I think you're going to have time to ride out the changes. So I financially modeled for them and said, well, actually, if we kept it at your moderate, here's where you're going to be at retirement. If we put it to growth and adjust that as you get closer to retirement, here's what you're going to end up with. So it's really important to have a look that a lot of people haven't revisited where they were at when they first filled out that form when they were 15, and they probably, were just told what box to tick on that as well. Growth investments, if you've got time on your side to retirement, you're going to have the ability to kind of, I guess, ride out potentially a storm. You're most likely, when you're getting to retirement, you may not want growth investments if you're really reliant on getting that pension income from the assets that you're building up. So it's one of those things that we like to tailor depending on the person's personality and appetite to risk, but also down to their timing. So some clients, it might be outside of super, they are conservative. They wouldn't be willing to invest in, Tesla stocks or Afterpay or something like that. And that's okay. But in super, they may have a different risk profile in super because they've got 20 years on their side to do that. So it's really important to have a think about what your overall, and it goes back to that goals-based advice that I was talking about. What's your end goal, and financially modeling it, I guess, so that you can have an informed decision on it. So with the super funds, just to give you an overview about the different types of super funds that are out there. I mean, we all, there's the personal, what we call retail super funds. So in the financial world, we often call them the retail funds. These are usually run by a financial institution and anyone can join it. It could be your MLCs or whichever, those types of ones that you've got. You've got your corporate funds, which are set up by employers for their employees through the financial institution. That was done a lot previously because before we didn't have a choice on a lot of our super funds. That was, probably 15 years ago, we all didn't have a choice. But sometimes the corporate funds can, depending on the fund, and that's why when we're working with clients, I'll look at it and say, is it useful to stay in that, or do we do something else, or keep it and then roll money out? So I've seen like one client recently, the corporate fund was, if you have all of your money, because remembering employees have a choice as to where they want to put their super now. You never used to have a choice, but you do now. The company will pay an extra 1% if you put your money into the corporate super fund. So I was looking at with a client, we'll take the extra 1%, we'll do it. And then probably, every 3 months or 6 months, we'll take the money, as much money out as we can and put it into their other super fund, So I kind of was trying to analyze, is it worth it? Because there can be some discounts in the corporate, could be group discounts, could be great insurance. So sometimes I keep it because there's a great insurance policy that they've been able to get on those. Then you've got your industry funds, the ones we all see where they're all like, doing this stuff, and you see them on the TV and the different things. They were originally for the workers in specific industries, but they generally are now open to anyone. I mean, I guess it's coming out to, there might have been the default one. Host Plus was the one that everyone in hospitality. CBUS tends to be the one that you see in construction, but they are open to anyone now. These super funds, I guess, from a returns perspective, and they do often say, oh, we have higher returns, we're reducing that back to our members. I think it's something that you've got to really look at overall, because when I'm looking at all the different funds, yes, some might have different returns, but they forget to tell you the little asterisks or the fine prints that says fees. So I know that there's been some funds that have, are called something, say, and they've got the word ethical in it, or they are ethical. And I remember one client actually said to me, well, they're not very ethical with their fees, are they? Because they're actually the highest fee super fund, So it's about, when we're looking at it, it's really looking at it holistically and going, okay, it's not just about, in theory, the returns, and also noting how do they present the returns, or sometimes they go, oh, we got X amount of returns over 12 months. They don't do it over, or they'll do it over 5 years, because whichever's tapered to them. So you've always got to peel the layer back 2 or 3 layers to get to the real facts on what were the real returns and what were the real fees. And look, some of them can be great, and some of them, and also it depends on your super balance. I know some of them, if your balance is under 100, the fees are really cheap. As soon as it goes over 100, boom, the fees are really high. So then kind of hands off. You're actually paying, the reason you're paying fees is you're paying fund managers and the trustee. You're paying them to do your investment strategy, your audits, your compliance, and all of that, and you don't have to do anything. Super goes in and you forget it. You can have the hands-on approach, which does require you to do work. So significant admin and compliance requirements, and that's a self-managed super fund. So then you have control of it, in a sense, yourself, but you do have to do a lot more of the administration on that side as well. So some of the, I guess, pros and cons of some of the self-managed super funds. Now, if you do go onto our website, and I can get Vivian when she emails this video out to maybe put the link in to where they are. I recently did 2 other webinars, one on is an SMSF right for me, because it's not necessarily right for everyone. And also another one which was very close to my heart, because I quite enjoy it, is investing in property using self-managed super fund. I like to say feeding your property addiction using your super. And that was a very popular webinar in going through that. So you can have a look at those 2 and see if that is something on it. But what's interesting about self-managed super funds, and I think people are getting more and more skeptical on maybe how super funds are being managed, or just how someone's managing their money, or they're realizing, hang on a minute, this is like ending up being a large amount of money, and I want to make sure I have control of it. So and so they've actually seen in the last 5 years, there is a 15% increase in the number of self-managed super funds. So as I said, it's not for everyone, because if you don't have much in super, and even as financial advisors, I cannot give you any advice on your superannuation into a self-managed super fund if you have a combined member balance of less than 200,000. So that's, I'm not insured if I do it, and if I'm not insured, my licensee doesn't allow us, and that's for all financial advisors in Australia. They brought in that new rule probably 2 years ago. So you do need to have a decent amount. I often say that, look, if you've got less than, I say 200,000, maybe, and then even up to 300,000, I say, okay, if you've got 300,000 and you're not intending investing in property, do you really want the pain and suffering of us as accountants annoying you for every invoice, every bank statement, every transaction, and managing the funds? And some people don't. So, but if you've got more than that, it can start to get a lot more cost effective. The interesting thing on the cost is that actually people forget that when you actually got it in a different super fund, you actually don't know how much it costs, because you just get the net return. When it's in a self-managed super fund, you're like, oh, actually, now I see actually how much I was paying. I mean, we had a classic example, Bianca, remember this one, where I said to the client, well, actually, you've been paying about $8,000 a year in fees for your retail funds. They're like, no, we haven't. And I'm like, well, yes, you have been. And you've actually done that for the last consecutive years. And they were like, no, we haven't. We definitely haven't. We would have known about it if we were paying $8,000. And I'm like, well, you did. And here's your statements and here's your figures. And they were absolutely not impressed. Let me just tell you that they were not impressed. So them being in a self-managed super fund has worked out a lot better. But it's just often, it's in the asterisks in the fine print. So it does give you greater control, wider investment choice. So if you look at those webinars I did and, you know, you like certain property, and don't just buy any property, you've got to be really, make sure you get the right one. It does give you some really good estate planning flexibility, and you can borrow, which is the greatest thing. So as I talked about before, about the investments, what I love about the self-managed super fund with borrowing is if you've got time on your side, you could potentially, and I've had a number of clients that do this, you know, maybe the clients love say commercial, they might like commercial and residential, but they buy a property, say a factory, they borrow, and it could be say 65% of it that they borrow. And that's paying itself off. They've got the rent coming in and that's paying itself off, and they start to kind of build up their super a bit more, and then they buy the next one, and then they buy the next one. So we've got a few clients that are up to like, I don't know, 3, 4, 5 in there, with the intent that once they get to retirement, remembering it's tax-free, once you get to retirement, they sell one, maybe they sell two, use the money, all tax-free, so all that capital growth, maybe they've had it 10 years, 20 years, and then they pay down all the debt on wherever possible on all of the others, and all of the income you get once your retirement, any rental income, is all tax-free. So, you know, you can also do this even just with your share investments as well. Now, the disadvantages is, you know, you will need to either manage the investments yourself or engage someone like us to do that for you. There will be administration time and some costs obviously on doing that. You'll have us chasing you for, you know, I need invoices, because it has to be audited, just the same as the big super funds. You need every single invoice, and you cannot touch the money at all. I often say to clients, put it in a Macquarie, completely separate bank account to what you do your day-to-day, so you do not touch it. But yeah, it's something to think about if that's what you're looking at. Probably most of you on this webinar, you're wanting to get a bit more proactive on your retirement. Doesn't mean you need to set up a self-managed super fund today, but I do have some clients where they'll be like, okay, I do want to do that. I do want to buy a property. So then I'll say to them, look, if you're not going to do that now, why don't we focus on building up your super? Keep doing that in your retail super fund, and then when you're ready for that property, then we can change it over, just to save them a bit of, you know, pain and suffering of us chasing them, I guess you could say. Now, the other one I'll just touch on a bit, because there are a lot of misunderstandings with transition to retirement. It used to be one of the greatest things that they had out there, and they closed down the loophole. So that loophole you probably still think exists. If you say, oh, I want to do a transition to retirement because I can do all of this switching of the money, pull it out, put it in, pull it out, put it in, and it's a great situation with the super. They got rid of the loophole on that one. So what a transition to retirement is basically saying that you're getting to what we call this preservation age. And as they got rid of that loophole rule, they did actually come up and say, look, we understand a lot of people were getting close to that. So they've done it based on the ages. So we have to look at it up specifically for each person based on their age as to what their situation is. And what it's enabling you to do is to be able to access some of your super earlier now. And if you're before preservation age, then you actually will pay some, I guess, extra tax, and you get 15. If you're before retirement, you're at preservation age, sorry, but before retirement age, you can take the money out of super, and that gives you an income stream, but you are going to have to pay tax on that money. And you're going to get a 15% credit on it because you already got 15% in a sense in the super fund has already been paid, but you are going to pay normal tax on it. So the transition to retirement strategy isn't something that people are doing as much these days because of that particular situation. But I did include a few case studies that I won't go in too much detail, only because I know I get a lot of questions on it because people do think of the old pre-loophole solved situation. But look, the reason that you might do a transition to retirement, if it's a tax focus, you might be working full time, you might want to maximize salary sacrifice contributions, but you are reliant on the income. So you might top up your income. You might put extra into super now that you normally wouldn't because you need that money to live on. But you might say, okay, I'll put the maximum and get the total tax deduction, but then pull down some on the other side. The lifestyle, and because you're getting the full tax rate on the way in, and then on the way out, you're getting the 15% credit. So that's where that is. It could be lifestyle. I'm getting closer to retirement. I still need a certain amount of money to live on, but I want to cut back my number of days I'm working. So you could be using it to supplement until you get to that retirement age where you can get it. But you are paying tax. And I think every time I've discussed this with people now, when they say, hey, I just want to grab some of my super, as soon as I explain, well, actually you're paying tax on the marginal tax rates. Yes, you get a 15% credit, but if you can just wait a few more years and you're not 100% reliant on it, you'll get it tax-free in a few years' time. So most people say, look, I'm not going to do the transition or the TTR year you call. But yeah, so it does give you some flexibility, but I did just want to touch on it because it is something that I guess a lot of people thought was it used to be a great strategy. It was actually a fantastic strategy before. And, you know, if something's too good to be true, that's when the tax man's going to change it. So unfortunately, they did. This was one of the ones they tried to get rid of when I guess the government wanted to get extra taxes. And so they used this as one of the ways of saying, well, actually, you know, we'll peel this one back. We're not impacting your super too much, but, you know, you can wait till retirement. So I did just do just a case study to just show as a quick example, and I won't go through that in too much detail, but just looking at, you know, having, say, Dave retires completely, he's 57, retires completely. This is his income. He's got 300 in super, and he's basically considering retiring or working part-time, and you know, he's not sure what he would like to do. Now, if he retires completely and draws a pension from his super, he'll only have if he draws a pension every year from age 57 until he's 65, he's only going to end up with $45,000 left in super by age 65. So the alternative, and this is where the transition to retirement can be useful in this situation, is if he does work, say, part-time, 3 days a week, and supplements his wage with a pension, you've got your tax and then you've got your net income, he's going to still have a retirement balance of 383 at age 65. So you can use this from a lifestyle perspective, not just tax perspective. You know, just another scenario, and we will email out these slides so you can always look at this in a bit more detail. But, you know, we've got Judy works 60, works full-time, no plans to change employers, income, accumulated in super, and aims to retire. She wants to keep working at the same time as increasing the retirement savings in super. So she wants to keep working full time, wants to increase retirement savings, but needs that money to live on now. So she's like, okay, well, how do I do that? What can I do? So one of the options is looking at this salary sacrifice. You know, here's the wage, doing the salary sacrifice, then putting money, then having a pension amount. So you put money into super, you've got the tax rate benefit of that, and then having a pension amount coming out with the 15% tax credit, and still being able to maintain a decent superannuation balance at retirement. So that's something I do with a lot of the financial modelling to see what would those different scenarios be. So accessing your super, I guess, what are your options when it comes to when you get to that age and you're allowed to access it? You know, what do? Leave it where it is, do nothing, cash it out, take it all out, or convert it to a pension or annuity. So I guess this again comes down to what your personal, and it comes at the goals. So I do say it quite a bit, but it comes down to your personal goals of where you're at and what you actually want to achieve overall. You may leave it where it is, remembering that once you convert it to a pension phase, and I'll touch on that in a bit more, you must take a minimum amount out once you've converted it to a pension. You may leave it where it is because you may get to retirement age and you've retired and you've actually got some funds that you can be, in a sense, living off for a few years outside of super. So you may not touch your super immediately. There's no requirement for you to touch it straight away. You may cash it out. You may choose to actually say, well, look, we've got these debts, and once I get to retirement, I'm going to take a lump sum out of my super so I can pay down those debts and not have any debt and be debt free. You can convert it to a pension or an annuity, which means you start to get, you convert it to a pension, it makes your whole super balance now tax free. And once it's converted to a pension, depending on your age, there's a minimum amount of a pension that you must take out legally. As you get older, it goes higher, but that could be a minimum amount of 4% of your member balance that must be taken out each year. You can take more, you can take as much as you want. And as you get older, that balance, that member balance percentage that you need to take out can get up to 10%. So this is a bit where I guess I'm playing with it with clients to work out, well, how much do they need to live on? Do we take a lump sum out? Sometimes I come up with a combination. It could be something where I'm like, okay, you know what, we're probably not, you're not going to probably need to access it till this age, when, or at retirement, let's take a lump sum, pay off that debt, and then convert the rest to a pension so that it continues on from that perspective. So this is where I think some of the really, I guess, the fun stuff, but a lot of the really good strategy is. Because the other thing is, once you take it out of super, and if you're not able to put anything back in, you've just taken a pool of money out of a tax-free environment. So let's say it's $500,000 and you go, oh, great, I'll just grab it all. You've taken it out of a tax-free environment and you've brought it into a taxed environment. So just because you get to retirement age doesn't mean every bit of income you earn is tax-free. It's only if it's in super. So you've got to balance. And I guess when I'm working with those that are retired, we're always balancing how much we're going to take out as a pension each year. Obviously, there's a minimum. Do we take it out more, or what does that do? You know, I might have a client that'll say, okay, look, actually, we want to get a new car, or we want to buy the caravan and the new car. That happens a lot. What does that do? And do we have enough in retirement to, you know, to do life till life expectancy? And what would that mean? So I might take a lump sum to buy that new caravan, or a lump sum to come out and be able to financially model it. But it's important to note that you don't want to end up, I mean, sometimes I even end up with too much outside of super. Sometimes I even turn down the pension that we may have done. At the moment, that's been a common thing because a lot of my retirees are not traveling around in their caravans. They weren't able to escape. They're not doing the overseas trip. So they're not spending as much money as we had all anticipated they would. So I've turned down their pension because I'm like, leave the money. If they're not spending it, I don't want it building up outside of super when I can't put it back in. And I want to keep my balance in super at a lower taxed amount as well. So pension and annuities, I always look at this, it depends on the clients. The pension can be one that I guess we can put you into a pension phase. There can be also, though, annuities where you're actually, in a sense, going in more of an agreement of a fixed term or a lifetime, regular income payments, guaranteed investment returns. There can be, I guess you have to research them for you to see what your overall goals are. A large amount of my clients do end up on the pension side where we have a lot more flexibility, but they're in a lot more control of it. So it really depends on your personal situation. There are some great annuities out there if you're wanting a certain amount, guaranteed returns. But there can be some situations that, you know, once you pass, and if you were to pass earlier than anticipated, once you pass, the asset's gone. So there's a few different aspects. So I like to go through those options with people. Now with this balance transfer cap, and because you've all joined this webinar, you're obviously focused on looking at retirement. I want to set a stretch goal, like a really big stretch goal of 1.7 million, you know, so as your member balance. Now, if you've got a lot of time on your side, you potentially might get there, especially if you get property into the mix and, you know, we see that going. What this cap is the government, it used to be every bit of money you had in your super was, once you got to retirement, and it went from what we call accumulation phase. So while you're accumulating your super, so you're working and putting money into super, you're in accumulation phase. Once you get to retirement phase, it basically converts your assets that you've got in your super, whether it be, you know, shares or anything like that, it converts it into retirement phase, and then you start having this income stream coming through. So this is where you start to have drawing down the income. Now, the taxman kind of said, and this is again going back to when they restricted those TTR strategies, is they wanted to actually say, well, look, we can't have people with, 5 million in their super 100% tax-free income. So we're going to cap it. They capped it at 1.6 million. That's now been indexed up to 1.7 million. Now, let's not get too concerned about that. There are only 2% of Australians have a super balance of 1.6 million or over. So it didn't impact everyone when the government did this. There was a lot of media on it. And I was actually looking at it and going, hang on a minute. What you're actually saying is any asset that you have up to now 1.7 million, any income you earn on that, that's 100% tax-free. And if you have a balance higher than that, you're going to pay 15 cents in the dollar on any income you earn on higher that. I don't think it's that bad a situation. And it did only impact, a small percentage. So that cap, basically it means that you can accumulate and then it gets converted to a pension, and all of the income you earn on that asset, whether it be shares, property, all the income comes to you tax-free, which is just the greatest tax. That's why I'm a big fan of super from that perspective as well. Now, you can have a situation where you have maybe a number of pensions. And I raise that because just because you got to 65 or whenever you're accessing your super and you've decided to start getting that retirement phase, you actually can still be putting more money into super. You could still be working part-time and you could still have money going in it. So you actually can end up with a super balance which has split amounts in it, some in accumulation, some in pension phase or retirement phase. And then, so you can actually have a mixture of the two, which is not an issue either. But then just to make sure that you're looking at it as an overall from an estate planning perspective, because you're building up all of your wealth in your business, you're looking at your retirement, and then you want to make sure that you've got it all buttoned up at the end. I'm always stressing to people to make sure that you've got up-to-date wills. When you're looking at your wills as well, this is one of my big things at the moment too. Make sure the will doesn't say that you actually that your family members must use a certain law firm and they can kind of charge up to the standard 5% commission on your estate or 5% of your estate. That's a standard Law Institute cap. Make sure it doesn't say that. So there's a few little things I can help you with some of those aspects that we've seen coming out. Make a binding death benefit nomination. So make sure if you've got a retail fund, industry fund, that you've actually got that nomination there. Or if you've got an SMSF, look at doing an SMSF will, because your standard will doesn't cover all of your super. Look at enduring power of attorney and make sure you understand the tax implications for your beneficiaries. So I've been working a lot with clients in estate planning. I've done a lot of extra study in this. I'm accredited in estate planning. Bianca's got hers. Paul's got his as well. There's a lot of tax implications around estate planning that people don't realise, and we work with lawyers to get that right, but they're lawyers, they're not tax lawyers. So there are some things on testamentary trust which can be great for either your children, or I often say to my clients also, if I've got those that may be similar in age, might speak to your parents. What have they got done in their wills, or has the will been done 20 years ago with none of this testamentary trust in it? So I will probably have a webinar soon about the testamentary trusts and wills to go in a bit more detail on what am I talking about tax implications, even some strategies on, did you know that actually if you inherit your parents' super because you're not a cis dependent, as they call it, you're going to pay actually 17 cents to the dollar tax on all of that income that your parents had built up. So there's a few things that you can do to try and minimize that. We don't have inheritance tax in Australia, but I do feel when it comes from super, it's kind of a little bit like inheritance tax, but it's really just the superannuation saying, well, hang on, super was a special tax environment to cater for those that that were contributing the money. If someone else benefits from it, and that's just under the superannuation laws, then there's additional tax that comes out of it. So that's something to really, I guess, proactively look at as well. So how can we help, like as a financial advisor? I guess going back to your goals, as a goals-based advisor, I like to work out, well, how much do you need? Build your super savings, make sure you can take control of your cash flow, look at paying off your debts and doing it smart, not paying off debts that maybe are tax deductible debts versus non-deductible. So really looking strategically at that. I mean, even paying off your debts. I mean, one thing I like to do is someone's got a negative gearing property is I say to them, look, hang on a minute, don't pay off that debt. We'll pay it off at retirement. I'd rather you pay, instead of an extra 20 grand a year off that debt, I'd rather you pay an extra 20 grand into super, get a tax deduction, and when you get to retirement, let's pull some lump sum and pay it off. They've just got to be comfortable with the fact that they've still got that debt in a sense until retirement. Looking at securing it from an insurances. I mean, insurances can be expensive, but if something happens, we want to make sure you're kind of covered. What can we get on the Social Security benefits, if anything, on those? A lot of my clients, I find, I don't have many that fall into that side. And then looking at the estate planning and preparing for retirement. But I'm always going back to the goals side of it and looking at it. You've got to have this, I call work-life balance. And balancing, enjoying today, enjoy the today bucket, but also balancing it with, the tomorrow. We don't want to get to retirement and be living on 2-minute noodles. So we want to balance it, on both sides as well. And I guess the big thing that when I'm working with clients on it is, we all think, oh, great, I've got an idea. This is the plan. I've set up my super and off I go. And it's never a straight line. It's obviously goes and, in circles. So we're often working with clients continually to kind of adapt on that side as well. So I'm happy to take any questions at this point. I've got one is it in the chat? Oh, no, it's a thumbs up. Thank you. So just looking at some of the questions, so feel free to put it's in the question and answers at the bottom. If you have any specific questions, was there any that's come through there, Bianca? Any
I've
questions?
just got a couple. When I retire, is all my money tax free?
So this is one thing that I have a lot of people get this wrong. So I'll just try and be really clear to make sure you understand. So that when you retire, you will not pay tax on any money that is in your super fund, whether it's a self-managed super, retail super fund, industry. If that money is not in your self-managed super fund and you're earning interest income, so it's just in your own bank account or you've got a rental property down the road, you will pay tax at normal tax rates as you do now. The first 18,200, no tax, then you gradually go up. So it's only, I think there's a lot of people that go, oh, once I retire, I don't pay tax anymore. No, you still pay tax, but if your assets are in super, you don't pay any tax on those assets. And that's one thing that I start to look at with clients is how much have you got in assets, how much is in super, and how can we try and even get more assets into your super so that when you get to retirement, you've got that there.
Yep. Do non-concessional contributions need to be placed or added on tax return?
It's not a tax deduction. No, it's something that you do with your super fund, and so it's not actually something that you're actually you're not claiming a tax deduction for. You just need to make sure that when you actually put that in, that you're actually communicating that with your super fund. And they'll have different forms. Some super funds, if it's in your self-managed super, we do all of that paperwork. But if it's in a retail fund, some super funds will actually have even different BPay, different bank accounts to put it in. So make sure you get it into the right bank account.
How do I decide whether to bring a UK pension to Australia?
I guess it comes down to, there's a few things to consider on that. There's actually, you're very limited with the type of, there's only one retail super fund that you can actually roll over a UK fund to, or you can set up a self-managed super fund that does have to have what we call this QROPS, which is an acronym, a QROPS part of the deed. Now that's a requirement from the UK for them to release the super and make sure it's actually going to be for your retirement. And then there's some other benefits around that. I guess it comes down to what do you want to do? And that's where, maybe you're building up your super here in Australia, you've got your super from in the UK, and in the future, you could get just your pension coming from the UK and you've got your pension here in Australia, or do you want that money from the UK and do you want to do something else with it? So it kind of comes down to how involved do you want to be in it, and how much do you want to do with your, how much do you want to get involved in your super overall. And because of the limitation that, from the UK, you've only got one retail fund in Australia that will accept UK fund rollovers, and therefore you probably end up in a self-managed super as well.
Does my will cover my superannuation?
No, so your will actually, a lot of people are quite surprised to find out that your will doesn't actually cover your superannuation. So that's, if it's a retail fund, it's that binding death benefit nomination. If it's a self-managed super fund, a lot of people used to do these binding death benefit nominations, but we've been working with lawyers to actually that you really should be doing more of an SMSF will as to what you want to do, because that overrides, especially these days. And the reason I'm focusing a lot on estate planning is the unfortunate thing with estate planning, and when it's not planned, because a lot of people just do a will, put it on the shelf, is if you have a disgruntled, whether it be child, relative, or someone thereabouts, and they start to make a claim on the estate, the issue is the estate pays for their legal costs. So at the moment, this is a booming industry in estate lawyers. That's an absolute booming industry, because you've got a situation where the estate has to pay for the legal costs of any of those that want to dispute the estate. So we had an example, actually, wasn't it, Bianca, we were dealing with when we're doing the latest accreditation, a real live example from one of the lawyers that they spent, the estate was only worth $500,000. The siblings were all fighting. They spent $400,000, and so in the end there was $100,000 left to be distributed to them all, $400,000 in legal fees. So it's really important to look at your wills from that perspective, make sure it's covered, and that's where this super fund will is, I believe, a lot stronger from what I've learned from the lawyers than a binding death benefit nomination to satisfy those areas.
Yep. That seems to be all for the moment. Does anyone else have any other questions? If you can pop them in the Q&A box down the bottom of your screen, please, and we can answer them for you.
Yeah. No others? Well, if you have anything else, feel free to reach out. We do have, if you go to our YouTube channel, you can like and subscribe. I can guarantee it's better than Netflix for sure. We do have, though, and we'll get those links sent out about the other ones on the SMSF as well. But I do have a number of also, what are investments, what's a managed account, what's a managed fund, because that can be different. So there's a few little short videos that we've recorded to kind of put things into plain English, so that it's, often a lot in the financial world is a bit more jargon as well. And you'll get any updates that come out. But thanks very much for joining us and taking a proactive step in looking at your retirement planning. I just think it's really a great opportunity to look at it, so that you can actually feel comfortable going into retirement without this last minute panic, but still enjoying life. And then sometimes actually going back to that goals-based advice, making a decision that may not be, the best tax outcome, may not be the best financial outcome, satisfies your goals. And one of the goals being, long-term, how it's going to impact your retirement. It kind of actually helps you overall be able to, I guess, have your cake and eat it too, enjoy life today, but also make sure you're planning for your retirement too. So thanks everyone for joining us. Feel free, if you've got any questions, to reach out, and we will send out a recording of this video as well. Thanks very much. And sorry I went over time, but it's just such an exciting topic. Thank you.
Thank you.